Good evening. This is Ken at Tortoise Capital on day two of the live trading workshop in Kansas. Quick look at the daily trading plan. First off, the market health check. Want to zoom in on today's price action. The high of the market was rejected. We had some downward pressure today. Still north of the dragon. We moved from that second Indian summer into fall, so the market is very vulnerable. The price stack of support on the downside remains in effect. Those are either support levels or price targets if the market were to collapse. There's still room for this to expand to the top. We did not really see panic today, but just lack of follow through. The entire metals and mining sector dominated today. We developed a new friendship with U.S. Steel. We expect that to be a 3-year relationship, as it's in an interesting location for swing and position trading in this trading range between 10 and 50. It's still early in that recovery, so an interesting company that is added to our Frog Champion list and our specials. I should also say there were some moments today when VXX finally raised its head and there was a hint of volatility to the upside and some gains that were made, but little follow through. But that's knocking on the door, and so that reinforces the narrative from this weekend about the vulnerability to the downside. I continue to assert that we're in a critical state for the market, and you got to get that right, and only then move on to more refined targets. So pay attention to the market right now, more than ever. That said, the market snuck into bullish quiet. The lack of downward pressure and the reduction of volatility makes it almost an anomaly that a bullish quiet, which is good statistically for the long run. So there you are. We're still overbought on an annual basis, at the high end of neutral on a 10-day basis because of that second day of a little bit of selling pressure. We're still green bullish price with respect to the 200-day. The risk Z is still risk on at 1.19. It's still a Z score, a risk Z of 1.21. However, when it starts rolling over at a distance of more than 1 SD above average, that is a caution to ensure that your swing trade positions are locked in. Be judicious about adding new positions and be ready for a change in tide. No signals in channeling and overreaction. 10-day max pain. There's a lot of the consumer staples in healthcare with Johnson & Johnson, Merck, Pfizer. ExxonMobil still weak in the energy sector, which was not impressive today. Moving on. Quite a number of dojis, 8 dojis in the Dow. We had a overreaction signal on the short side for 3M. That means its harsh sell-off has had enough of a rebound to indicate that this is prime candidate for short sellers to come in and pound it. So if the market gets weak and 3M is weaker, then that's a likely candidate to get crushed. Now, interestingly, it had a 10-day breakout and a 1-month breakout to the upside when you look at the NDX. So that's interesting, but that's just enough to get people's attention who might want to get short again on it. Merck, Johnson & Johnson, and Pfizer test out well on the auto framer on the max pain range compression side. A couple washouts or short-term weaknesses in RSI2. That's Johnson & Johnson, so again, very interesting. And ExxonMobil. Single digits in RSI2 suggest short-term washouts over the last 2 days that is now postured for upside momentum or continued downside momentum. So Johnson & Johnson, especially interesting since it's one of the big percentage losers in the Dow on 1-day, 10-day, and 1 month. Further down in the stack, you see Goldman was a percent winner today. and it had breakouts on the NDXs for 10-day, 1 month, 3 month, and 6 month. Procter and Gamble, with no other patterns in force, had breakouts on those days as well, and was a doji, so that's a candidate for continued quiet momentum to the upside. So lots of things to choose from here. Notice that there's 5 that now have frog quality numbers greater than 3. That's characteristic of markets that have compressing volatility, which is what we're in with that bull quiet. So some special cases in the frog quality number there. ETF 30, a few dojis, some channelings in treasuries, Japan, healthcare in Europe. All of those are flights to quality, you might say, away from the U.S. markets and into more defensive sectors. 5 test out well on the auto framer, including treasuries once more. Treasuries have stemmed their losses and had only micro losses today, so that's interesting. Oil exploration had a breakdown in the 10-day NDX. On the upside, silver, so therefore Wheaton precious metals should still be on your intraday frog champion list. Silver had breakouts today in 10-day, 1 month, and 3 months. XLI, the industrials, probably the single strong sector today, so names like Alcoa, Caterpillar, U.S. Steel, Cliffs Natural Resources, love it. They all benefited from the strength in the broad sector. Pinch and stretch report, the usual suspects. United Health and silver had stretches to the upside, so I'd think I'd be looking at United Health, which seems to be a leader in that segment. So the folks that learn how to pair trade this week might look at the sector spider for healthcare and compare that to UNH. On the negative Z stretches, Johnson & Johnson and Merck stand out. Coca-Cola on the most expanded pinch box with a negative 1.38 means that is a compressed river. So that's the lack of directional volatility, so that Coke is of interest for us there. Lots of compressed pinch boxes where the z-score is less than 1. That means that all of their rivers are abnormally pinched. So this is a nice condition for that range expansion in either direction. Those typically are moments of indecision and lack of volatility. I like that Mexico is in there, and Coca-Cola and Verizon. Verizon deserves a look simply because it's almost at 2 sigma in terms of how compressed that is. So swing traders might want to take note of that one. Okay. Oops, excuse me. Yeah. Auto framers, the usual mechanical swing trading 1 day at a time. Merck, Johnson & Johnson, Pfizer, XLV, the usual suspects. In the regression line fractal framework, the top shelf in the green are the symbols that are the most ATRs below their RL270. Not much to choose from there. Johnson & Johnson is of interest, and Merck, just because of reasons earlier given. The more interesting ones are the relative strength leaders in the bottom stack in the red, and that shows you how many ATRs beyond their RL270 they are. If the market were to experience significant sell-offs from here, these are the candidates where the people who own them and have been enjoying the ride up might be tempted to rapidly sell to preserve profits. So even though they are relative strength leaders, it's not unusual to see those experience short-term profit taking that leads to expanded downside ranges. So if you're in them, make sure you're protecting them. If you're not in them, you might want to frame that in both directions, so that if the market starts to work to the upside, leaders should continue to lead, candidates for increased momentum to the upside. If the market fails, then protecting the leadership could result in short-term opportunities so I would be looking at things like, Home Depot and Walmart stand out to me. Daily squeezes. These are 1 day range compressions where if you get a mechanical entry and it just simply gives you a range stat with a trailing stop of a range, you could see 3.5 to 1 reward to risk in General Dynamics and United Tech. Boeing is of interest. The fact that DIA is on there is interesting because that tells you just how compressed the broad indexes are. So the Dow 30 itself is in an interesting location. Finally, the Four Seasons of MACD. There's only one in the winter, and that's EWW, Mexico. The large number of symbols that are in the fall and only a few in the summer tells you just how powerful this move up has been, that most everything is north of the zero line. The ones in the summer haven't rolled over yet. Notice some defensive plays like utilities, Latin America, real estate, consumer staples. Those are all defensive plays. And all of the other ones in the fall have failed to follow through at the same rate that got them there. So they're starting to roll over and are now in danger. So make sure your stops are in place if you own any of those. And that's everything I want to cover for this weekend, or for this day. Take good care, keep your risk measured and your powder dry. I should tell you that the breakthrough thinking that we had today and yesterday is going to represent about a 40% new material being added to the day trading techniques. Things like visual box trading, the use of the RLFF for trade framing, simplified risk management with visual box trading, some psychological insights about how to create a relaxed entry to improve your trade management. We had such interesting ideas that I think this is some groundbreaking material are going to be added. They're going to be about 40% of the course that I teach and carry in September, and that might be of interest to you as you think about adding a subscription or renewing your subscription at current rates, because on 1 October prices are going up. So consider your options. More to follow on this weekend report, where I'll lay out the numbers and the argument in favor of subscriptions at these current prices. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.